we had the rand trading down below 720 again briefly yesterday, and we had the US Fed coming out with that policy statement agreeing to roll over mortgage-backed securities that they bought at the height of the financial crisis into new treasury bond purchases. The rand, though, back in the back foot this morning, back around 727 against the dollar.
Yeah, absolutely, Stephen. I think it's very much a case of risk off again after the Fed's gloomy outlook for growth, and the fact that they need to embark on a second wave of kind of quantitative easing is a clear indication that the US authorities are concerned about the pace at which the US economy is recovering. We saw, of course, some weak figures out of China yesterday from the import side. We saw a few more disappointing figures out of China this morning as well. And if you combine that with the poor data that we've seen out of the US in recent weeks, a fairly dovish FOMC last night, and of course our expectation that European growth is going to suffer at the hands of all the austerity measures that are going to be implemented over the coming months, I think it's quite clear that the global growth outlook looks quite precarious, and that's why we've seen risky assets coming off. We've seen it in the equity space, and we've seen it in dollar rand as well.
So the dollar rand from these levels, of course, we had it last week trading down to 717 on Friday. From these levels, would you expect it to stick in the range that we have seen, that 720 to 730 range?
Well, Stephen, as you know, I'm quite bearish on this rand at current levels. I think it's very rich down here, and of course it's not helping our economic recovery prospects back in South Africa. I think the rand is overvalued and needs to weaken from current levels, and of course much depends on global sentiment. And if you see a follow through in this risk aversion and people become more concerned about the global growth outlook, they're probably going to go back, ironically, into US treasuries, the dollar and the safe haven plays, and that could drive the rand weaker. I think that's the predominant force, the global influence, but of course domestically it's not a bed of roses either. If we look at the strike activity that we're seeing at the moment, of course there's a lot of negativity surrounding mining rights, nationalisation of mines, all those negative sentiment, developments, and then we've got some more data out this morning, the manufacturing data, and that's probably going to disappoint.
Of course, that's the manufacturing data for June, and we were chatting yesterday, we already had July's PMI out, and that was still looking pretty grim, below that 50 level. June, though, was the worst month for PMI this month, so do you think June could be the worst month for manufacturing as well?
Well, I think so. I think, Stephen, the writing's on the wall. This rand is very strong and global demand is weak, so the manufacturing sector is going to have a hard task in getting a recovery on track and sustaining that recovery. So I would expect that the manufacturing sector will remain under pressure, and of course that doesn't bode well for the rand or the economy from a GDP differential perspective, and that's why I say I think globally and domestic factors are rand negative at this stage, and we would like the rand at weaker levels from here.
Well, just looking forward, you said the manufacturing data out today. Globally, what do you think is going to be driving the markets at this stage, the currency markets in particular?
Well, of course, we saw a lot of action post the FOMC last night. A clear message from the Fed that they are concerned about growth, and I think that's probably going to dominate the theme for the rest of the week. We've had quite a solid run for risky assets over the past couple of weeks. And it's really, I think, partly been a function of a weak dollar environment, but also people saying that they need to put the money to work. There's cheap money, a lot of liquidity out there. They need to put it into emerging market assets. But at the end of the day, those emerging markets are only as good, and their performances will only be as good as the final demand coming out of the developed nations. And as the Fed painted quite clearly last night, growth out of the States, out of Europe, China, that's all slowing. So I'm not constructive on emerging markets as possibly a lot of other people are.